If you're wanting to buy a home, then make sure you watch this video until the end because I'm going to tell you how to save hundreds of dollars on your mortgage. Hey guys, it's Clem again. Millennials in Canada are facing a very different home buying environment than their parents. Soaring real estate prices, high levels of student debt, and precarious employment situations are making it very difficult for young people to get into the housing market. Despite these challenges, a recent survey found that 80% of Canadian millennials want to own their own home. What's more, 27% already do. If purchasing a home is a goal for you, here are some tips to guide you through that process. See what it will cost. Look at home prices in and around your desired location and be realistic about what you can afford. Perhaps moving to the outskirts or setting your sights on a smaller property can bring costs down. You might also need to think outside the box a little, like bringing in a tenant to help lower the carrying cost of your new home. Keep in mind the purchase price is only one part of the equation. Closing costs such as real estate commissions, legal fees, and land transfer taxes can add an additional 4% to the purchase price. You'll also want to factor in ongoing expenses, things like property taxes, mortgage insurance, utilities, and maintenance. Be sure to save for your down payment. If you aren't already saving, start now. If you can put down 20% of the purchase price, you'll avoid needing to purchase mortgage insurance, which can add thousands of dollars over the course of the mortgage. If not, at least 5% is required for first-time buyers. Consider setting up a dedicated home buying fund and putting aside money from every paycheck. Pad your savings with tax refunds and any bonuses or gifts that you may receive. You may also be able to negotiate a personal loan from your parents or a family member to put towards your down payment. Learn about government perks. You can withdraw up to $35,000 tax-free from your Registered Retirement Savings Plan, RRSP, through the Home Buyers Plan to put towards your new home. This amount will be repayable in installments back into your RRSP over 15 years. There's also the First-Time Home Buyers Incentive. This federal program was introduced in September 2019 to help first-time homebuyers reduce their mortgage payments and also the total interest paid over the life of the loan. It's available to households with an income of $120,000 or less and offers a loan of 5 to 10% of the home's purchase price to put towards the down payment. The incentive is repayable when the property is sold or after 25 years, whichever comes first. A potential drawback to this program is that the repayment is based on the fair market value of your home at the time. If it increases in value, you'll pay back more than you borrowed. There's also the First-Time Homebuyers Tax Credit. New homeowners can claim a non-refundable tax credit of up to $750 to cover closing costs. There's also the GST or HST New Housing Rebate. If your home is a new build and costs less than $450,000, you may be able to recover a portion of the GST and HST that you paid for the home. Your province may also offer rebates on the provincial portion of the GST or HST. Land transfer tax rebates. Some provinces and municipalities, for example Ontario, British Columbia, Prince Edward Island, and the City of Toronto, offer rebates on the land transfer tax for qualifying buyers. Explore your mortgage options. When shopping for a mortgage, there's more to consider than the rate. That's why it's so important to seek help from a professional. For example, a flexible mortgage that allows you to make prepayments can help you pay off your mortgage sooner and save on interest in the long run. Think about your personal situation. If the possibility of rising interest rates makes you nervous, you might be more comfortable with a fixed-rate mortgage. If you're expecting changes to your financial situation, then an open mortgage may be ideal. You can also customize your mortgage by splitting up between a fixed and variable rate and an open and closed mortgage. Get pre-approved. Before applying for a mortgage pre-approval, it's a good idea to review your credit rating and report any errors. You can request a copy of your credit report once a year for free from Equifax Canada or TransUnion Canada. With a mortgage pre-approval, your lender will let you know how much it is willing to loan and the estimated size of your payments. The current interest rate will also be locked in, so you're protected in case rates increase before you purchase your home. The lender will also apply the mortgage stress test to ensure that you can make your payments if interest rates rise. It's important to note, a mortgage pre-approval is not a guarantee that the lender will grant you the mortgage. When it comes time to make an offer on a home, it's a good idea to insist on the condition of financing. It protects you in the event your financing falls through, and if you waive it, you could lose your deposit and risk being sued by the seller. Don't shop alone. Buying a first home can be exciting and challenging, but knowing what to expect can make it a lot easier. A team of experts including a financial advisor, mortgage professional, real estate agent, and a home inspector can help you figure out your options and ensure you're making the best decision possible. Here are some mortgage terms that you need to know. Principal. Principal is the amount of money that you borrow to buy your home. With every mortgage payment, some of the money will go to paying down the principal and some will go towards paying the interest. Fixed interest rates. Fixed interest rates will not change during the term, and your payments will also stay the same. Variable interest rates. Variable interest rates are usually lower than the fixed rates, but are subject to fluctuations. Mortgage term. Mortgage term is the length of time you're committed to your lender, the rate, and any conditions. 5-year terms are most common, but you can choose anywhere between 1 and 10 years. Open term mortgages. Open term mortgages allow you to pay back what you borrow at any time without penalty. Because of this flexibility, interest rates are generally a little bit higher. Closed term mortgages. Closed-term mortgages do not allow you to pay back the entire balance without penalty, but many offer some prepayment options to help you pay down your mortgage sooner. Amortization period. Amortization period is the length of time before you pay off your mortgage, up to a period of 30 years. The longer the amortization, the lower your mortgage payment, but you will end up paying more interest over the life of your mortgage. This could be the difference between paying $120,000 in interest on a 25-year mortgage and $200,000 in interest on a 30-year mortgage. Mortgage insurance. Mortgage insurance is needed if you have less than 20% for your down payment. This insurance protects the lender in case you can't pay for your mortgage. Make sure you talk to a mortgage broker after educating yourself first, so you actually know what it is that you're getting into before signing on the dotted line. I hope you learned something new in this video. Please don't forget to like and subscribe to help out the channel.